Did Ripple just secure an OCC banking license? That question started circulating heavily across X, and when rumors like that begin trending, you have to separate speculation from what is actually moving price. There's a lot of XRP related news from the past 24 hours that we haven't covered yet, but before we even touch that, we need to address what's happening with the Clarity Act and Bitcoin because that is what's driving the broader market right now. Earlier projections had the probability of the Clarity Act getting completed this year or into 2026 sitting around 85 to 90%. That has now reportedly dropped to 39%. That is not a minor adjustment. That is a collapse in legislative confidence, and markets react aggressively when expectations shift that dramatically. This isn't just about XRP speculation, it's about structural clarity for the entire digital asset space. And when perceived odds fall off a cliff like that, capital responds immediately. Last night, Bitcoin dropped 5% in roughly 2 hours, sliding from 67,676 down to 64,344 between 7 and 9 p.m. Eastern. That move alone triggered roughly $500 million in liquidations across crypto markets within 24 hours. We are now 139 days into a broader correction that has seen Bitcoin fall 49% from its 126,000 peak. That's approximately $1.2 trillion in market capitalization erased. At the cycle high, total crypto market capitalization was pushing near $4 trillion. Losing around a quarter of that value is not a small pullback. That is systemic deleveraging. At the same time, the fear and greed index has returned to 5, which is historically extreme fear territory. Those readings are rare and typically associated with capitulation phases. So, what likely triggered the latest leg down? Recent tariff announcements from President Trump combined with thin weekend liquidity created the perfect environment for aggressive sell pressure. When liquidity is shallow, large orders have outsized impact. Volatility expands quickly in both directions. And here's the reality: volatility is probably not finished. These environments are designed to test conviction. 49% drawdowns shake out weak hands by design. Extreme fear is uncomfortable, but historically it has also been where long-term capital quietly accumulates. Now the technical focus shifts. The 65,000 level held as support back on February 12th. That level broke last night. The next psychological level is 60,000. If price stabilizes and liquidations begin declining, that could signal the flush is nearing completion. If we cascade lower, fear could intensify further, and this is where the Clarity Act narrative ties back in. Bitcoin appears increasingly correlated to legislative probability. When approval odds were high, confidence held. When those odds dropped to 39%, price reacted. That correlation is what the market is watching right now more than any rumor about Ripple. When something negative hits around the Clarity Act, you can literally watch the market react in real time. The probabilities drop, sentiment shifts, and almost immediately you see people selling Bitcoin and panic starts creeping in. That's exactly what we've been seeing. On top of that, crypto liquidity has now fallen to levels we haven't seen since the FTX collapse. USDT supply alone has dropped more than $3 billion in the last 60 days, which mirrors the type of contraction we saw near Bitcoin's 2022 bottom. When stablecoin supply shrinks like that, it usually means capital is leaving the system. Investors are pulling money off exchanges, moving to the sidelines, or exiting completely. But here's the part most people forget. Historically, these kinds of liquidity contractions tend to happen closer to the end of sell-offs, not the beginning. Major reversals often begin once outflows slow down and liquidity stabilizes, and crypto liquidity drives everything. Liquidity. If money is flowing in, prices expand. If money is flowing out, prices compress. And right now, we are clearly in contraction mode. Look at the chart, and it feels like we're not even on the visible mountain anymore. We're underneath it. It feels like an iceberg phase where price is hanging below structure and confidence is thin. It doesn't look good on the surface. But at the same time, you still have major voices stepping forward saying they believe the Clarity Act will get done. Brad Garlinghouse has been vocal. Anthony Scaramucci has been vocal. They're talking with lawmakers on Capitol Hill. They're saying there is strong incentive for both parties to finalize a deal sooner rather than later because going into midterms without clarity could be politically expensive. Several Democrats, including leadership figures, reportedly want this resolved. The idea that this drags endlessly doesn't align with what some insiders are saying. In fact, there are arguments that it could get done even before previous timelines suggested. That's the tug of war right now. On one side, you have collapsing probabilities and fear. On the other side, you have industry leaders insisting progress is still happening behind closed doors. Brad Garlinghouse reiterated recently that the broader crypto industry largely sees this as a necessary step forward, even if it isn't perfect. The key word is clarity. Markets function better with rules of the road. When you zoom out, the real issue is creating a level playing field. Interestingly, you've seen leaders like Goldman Sachs CEO David Solomon advocate for regulatory clarity as well. That's significant because traditional finance wants defined parameters to compete fairly with crypto native firms. A few years ago, major banks were dismissive. Now the tone has shifted. Even Jamie Dimon has moved from outright hostility toward more constructive commentary. Over the next decade, that convergence likely continues. Meanwhile, price action remains pressured. Bitcoin is down roughly 3% over the past week, and most of that drop occurred within the last 24 hours. We're hovering around the mid 65,000 range while XRP sits near $1.37. At the same time, speculation is growing after a Ripple executive posted an image of four aces on social media. In poker, that hand signals strength, though technically not the absolute best possible hand. Still, symbolism matters online. Some are interpreting it as a signal of a major regulatory win, potentially tied to banking status. However, there is no official confirmation. Ripple only received conditional approval for a national trust charter in December, and typically these processes take 12 to 18 months. Getting full approval in just a few months would be extraordinary. There has been no formal filing or regulatory notice confirming anything beyond conditional status, so for now it remains speculation. XRP trading volume has surged aggressively across major exchanges, and that's something you cannot ignore even if the price itself hasn't responded in a dramatic way yet. Upbit, Binance, and Coinbase have all reported noticeable spikes in activity over the last 24 hours. That kind of synchronized volume expansion across multiple top-tier platforms usually signals that something meaningful is happening beneath the surface. When volume rises without a corresponding price breakout, it often indicates accumulation, distribution, or heavy repositioning. The divergence itself is what makes it interesting. Price looks relatively calm compared to the surge in trading activity, and that tension between volume and price can sometimes precede larger moves. At the institutional level, exposure continues to expand quietly. Goldman Sachs, through various client-focused funds, maintains exposure to XRP-related products. Technically, those assets are owned by customers under custodial structures, but institutional pipelines are clearly open. That matters because institutional involvement brings liquidity depth and long-term positioning, not just retail momentum. At the same time, more than 31 million XRP reportedly moved into Binance in a single day, much of it originating from whale-sized wallets holding between 100,000 and over 1 million XRP. Historically, when large holders transfer tokens from cold storage to exchanges, it raises eyebrows. Whales typically store long-term holdings offline for security. When they shift to exchange wallets, it usually signals preparation for liquidity, whether that means partial selling, hedging through derivatives, or strategic repositioning. Large holders are not moving funds for minor staking incentives. They move when they anticipate volatility or opportunity. That does not automatically mean a sell-off is imminent, but it does mean liquidity is being staged. Meanwhile, network fundamentals continue showing strength. Daily successful transactions on the XRP ledger have climbed roughly 40%, approaching 2.5 million transactions per day. That is meaningful real usage growth occurring even while price struggles. Strong on-chain activity during price consolidation can reflect underlying demand independent of speculative cycles. On the fund flow side, crypto investment products have now recorded a fifth consecutive week of outflows totaling nearly $300 million. Bitcoin and Ethereum accounted for the majority of withdrawals, while XRP saw a modest but notable inflow against that broader negative backdrop. Regionally, the United States led outflows, while countries like Switzerland, Canada, and Germany attracted combined inflows exceeding $50 million. That geographic divergence shows capital is rotating rather than disappearing entirely. Additionally, futures open interest tied to XRP has reportedly increased, which implies more capital is being committed to forward contracts and settlement structures. As open interest rises, token lockups increase to back those contracts, tightening available circulating liquidity. If Ripple were to achieve full banking integration in the future, XRP could potentially anchor significant cross-border payment flows, but that remains speculative. Even broader uncertainty persists as Vitalik Buterin has reportedly sold thousands of ETH recently, reinforcing the reality that major figures are actively managing exposure. All of this paints a mixed but highly dynamic landscape. At the end of the day, there is both good and bad unfolding simultaneously. How you interpret that depends on your time horizon. The technology hasn't changed, blockchain adoption continues, AI integration with decentralized networks continues. None of that disappears because of a liquidity contraction. But the path forward is never smooth. There will be violent moves up and down. Turning modest capital into life-changing outcomes is supposed to be difficult. This is part of that process. It tests conviction. It forces you to evaluate risk tolerance. Some investors will step aside, others will continue accumulating. Personally, I understand the fear. I feel it too. But I also recognize that innovation cycles rarely move in straight lines. If you believe in the long-term thesis, then volatility becomes part of the journey rather than the end of it.